Good morning, and welcome to the Daily Hunt for Multi-Baggers. It's Saturday, November 15th, 2025, and we're looking back at the data from yesterday, Friday the 14th.
Well, Ethan, we saw a lot of chatter across social media yesterday. Many different stocks flagged, and honestly, the market sentiment was a real mixed bag. Some strong optimism, but also a lot of caution.
Absolutely. Let's dive right in. First up, we've got IREN Limited, IREN. The community, despite some recent price drops, is really bullish, seeing a long-term recovery in the AI infrastructure space. There's chatter about enormous institutional buys and a belief that we're near the bottom, which to me shows real growth potential. News even confirms institutional interest from big names like Alpine Fox and Jane Street.
Hold on a minute, Ethan. While that user sentiment sounds nice, the KPIs paint a starker picture. IRN has an extreme beta of 4.22, meaning it's incredibly volatile. And get this, a net profit margin of only 0.76. News even suggests its earnings are of questionable quality. That, combined with a high debt-to-equity ratio of 33.57, just screams risk. It's been mostly a stay away in our previous AI-generated insights, and these numbers don't suggest a change.
You make fair points, Brooke, but the institutional backing and its position in the booming AI sector can't be ignored for future prospects.
Perhaps, but the current financial health indicates significant caution.
Our verdict for IRN is to stay away. Next, let's talk about NVDA Corporation, NVDA. Users are celebrating non-stop gains, and honestly, the company's fundamentals are robust. 55.6% revenue growth and a fantastic 52.4% net profit margin. Analysts are raising price targets, calling it a top AI stock with huge expectations for Q3 earnings. That's a strong bullish signal if you ask me.
Ethan, that's all true, but the market commentary suggests those gains might be unsustainable. We're looking at a PE ratio over 53 and a price-to-book ratio over 46. That valuation leaves very little room for error. And while the profit margins are excellent, the debt-to-equity is over 10, and its beta is 2.269. That kind of volatility and leverage at such a high valuation makes it incredibly risky.
But the growth story is real.
It is, but at what price? Users are even suggesting to get out before the circular investing trick destroys market confidence. Our AI-generated insights have leaned stay away recently for a reason.
Our verdict for NVDA is to stay away. All right, moving on to NBIS Group, NBIS. Now this one's exciting. The community is incredibly bullish, citing massive contracts with Microsoft, potentially up to $19 billion, and Meta with a $3 billion deal. There's talk of a 237.4% revenue growth rate and a Goldman Sachs target of $155. Users see the current price as a temporary dip before the stock truly moons, especially with institutional confidence from NVIDIA.
Whoa, Ethan, pump the brakes on the moon talk. While those contracts sound huge, let's look at the actual financials. The PE ratio is a staggering 103, suggesting immense overvaluation compared to current earnings. And critically, their operating margin is negative 89, with a net profit margin of a mere 0.6. This means they're burning cash on operations right now, not making a profit. And a debt-to-equity ratio of over 93? That's a massive amount of leverage.
But Brooke, the community argues those negative margins are because they're in an infra build-out race, investing heavily to fulfill those future contracts. They say the committed revenue is literally larger than their entire market cap. That's why users believe it's undervalued.
It's a high-stakes gamble on future execution, Ethan. We've seen NBIS rated stay away multiple times because the current financial health is extremely precarious. Until those contracts translate into actual sustainable and positive profitability, the risks are just too high.
All right, let's bring some positive vibes back. Micron Technology, MU. This one is genuinely thrilling. Users are celebrating significant gains, and it's trading near its 52-week high after a fantastic year. Morgan Stanley just labeled them a top pick because of an ongoing memory chip shortage. We're talking 46% revenue growth and a very healthy 22.8% net profit margin. All systems go, in my opinion.
Well, Ethan, I have to agree. It's refreshing to see a company with strong positive sentiment backed by solid KPIs. The PE ratio around 31 is a premium, yes, but given the analyst upgrade and the market dynamics of a chip shortage, that valuation seems more justifiable. These factors certainly have the potential to drive continued growth and profitability.
This is an upgrade from its recent stay away rating. Exactly. This one has real potential. Our verdict for MU is to buy. Last up, we have Strategy Inc., MSTR. Michael Saylor continues to aggressively accumulate Bitcoin, denying any rumors of selling. If Bitcoin has a strong recovery, MSTR could see a massive rebound because of its leveraged position.
Ethan, that's a very speculative if. The user sentiment is overwhelmingly bearish, with comments calling it a sinking ship and even a Ponzi scheme. The stock is at its 52-week low, down from over 500 to under 200. We're talking about an extremely high debt-to-equity of over 14 and a beta of 3.37. News shows it's already fallen below its net asset value amid a crypto crash.
But for those who believe in Bitcoin, it's a way to get exposure.
Or a way to incur massive losses with amplified volatility. Many users point out that direct crypto or ETFs offer a less risky, less complex, and less leveraged alternative. This remains a highly speculative market commentary.
All right, Brooke, let's wrap up our hunt for today.
Here's our compiled list for deeper analysis based on our AI-generated insights for Friday, November 14th.
Investigate as buy. Micron Technology, MU. Investigate as cautious buy. None. Investigate as speculative gamble. Nebius Group, NBIS.
And that wraps up another episode of the Daily Hunt for Multibaggers. Just a quick reminder, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for joining us.
We'll catch you next time on the Daily Hunt for Multibaggers.